Hi, everyone. This is Rob Roy of LA Wave Options, and welcome to the official launch of our LA Wave Options Time Strategy. If you've seen my videos in the past, you can tell by the background that I'm still the cabin in the mountains where it is snowy and cold. But what I'm going to share with you this evening is as hot as it gets. The time strategy is profiting from theta decay. If you're an options trader, you know the one of the absolute facts is the fact that time decay occurs. Theta decay. If we can profit from that, one of the givens in the world of trading options, step forward to having a profitable trading career. So pretty excited to share this official launch with you. Again, if you've seen any of our videos, you know we have to show you this disclosure/disclaimer. Please take a screenshot of it, read it in detail at your leisure. If you're watching live streaming on YouTube or one of the various social media platforms, welcome to you. Again, please take a screenshot of this, read it in detail, but a couple of things that the powers that be want us to make you aware of. Mainly, we are not registered to give individual investment advice in the United States. The rest of it's important too, but please take a screenshot of it. But happy to share this throughout live streaming, the various social media platforms, etc. Been a long time coming and getting to this point, and very excited to present this information to you. During the session, what we'll cover is the genesis of the time strategy, an overview of calendar spreads, which is the primary strategy, but not the only strategy involved with our time strategy. This is what's really cool, integrating AI into the trade selection. Just last week on CNBC, one of their headlines is, how is AI going to affect trading in the future or trading in the markets in the future? Just last week. So we're already presenting a strategy based on AI. We feel like we're on the cutting edge. We're in the forefront, whatever you want to call it. We're out in front. We're a leader in integrating AI into trade selection. We'll talk about the results. Obviously, that's the most important thing. Does it work? And then how to access the strategy if it's something that you feel you would be interested in adding into your own trading. We will give you an opportunity to ask questions. We have John all the way from Australia for support. He can answer questions for you throughout the presentation, but we will open it up to live Q&A at the end. So at that point in time, you can submit your questions throughout the presentation if you have one, and John will join us and help instrument the question and answer session at the end. So we want to make sure that we answer any of the questions that you may have, and you may have some for this, but again, go ahead and ask him throughout the presentation. If he can answer them previously, he will. So with all that as a preface, let's get started. So why are we introducing a new strategy? LA Wave Options has been around since the beginning of 2018. We have a number of strategies that have been extremely successful. Our current strategies are mainly directional, which means time decay works against us because we are long only. We don't do naked options. We don't sell naked options. And so since we're basically long, time decay becomes an enemy. You get the direction right, but you still have to get the direction right within a period of time. So, it's challenging. We've done very well, but that's still a problem. What if we could solve that one problem? And we feel. Having the long only strategy, if you have a number of positions open at the same time, that significantly reduces your available trading capital. So adding a new strategy with different characteristics can offset this aspect and make trading easier for subscribers with less capital. We understand that not all subscribers have big, massive accounts to where they can put on huge trades. And that's kind of where we want to be with LA Wave Options, is we want to be for the average trader. You see some of the advertisements on TV. Well, if you have an account of 500,000 or more, contact us. Well, that severely limits the number of people that you can get to. That's never been my point of view. I was a registered securities principal at one point in time, and I was amazed when I would attend the meetings of the institutions, how much they talked about the bottom line for the institution and never bringing up the bottom line for the individual investor. Well, we want to be here for that average trader. So the genesis of the idea, where it came from. Over the years, I observed that after a stock had a significant drop, it would tend to trade straight it would tend to trade sideways, stay in a trading range, if you will. So you can see the example in the chart here. Stock had a big drop, and then it goes sideways within a channel. Well, when a stock has a big drop, they're going to spike the implied volatility. So that seemed like an opportunity to capture that IV skew, if you will, which means they are going to spike the IV more in the short-term options, the near-term options, than they are the long-term options. You may wonder why. Because the majority of traders trade short-term options. The overwhelming volume is in near month or front month options, 30 days or less. Not as many people trade further out. We are in an instant gratification society. We want results now. And then people look at it and say, well, you know, convinced they're going to be right in a short period of time, so they buy a short-term option. So they spike the IV in the shorter term options far more than they do in the greater. So that's what an IV skew is, the difference between the IV on the short term option versus the IV on the long term option. And then capturing time decay, if the stock stays sideways and is not moving, but days are going by, can we profit from that as well? So those are the two things that created the idea for creating this time strategy. And looking at put counter spreads showed out to be a standout strategy for taking advantage of those two variables that I just mentioned, the IV skew and time decay. So let's go through and take a look at what a calendar spread is. And it's also known as a time spread, which kind of gives you the idea of where the name time strategy came from. But what a calendar spread is you buy the longer term option and sell the shorter term option. So there we go. There's the setup of what I just mentioned. We're going to sell the short term option with that big IV skew, and we're going to buy the long term option that didn't have such a significant IV skew. It's almost like free money, that skew, because at some point it's going to come back down and the two volatilities will start to coincide again. You'll see the lines on a graph that I'll show you in the not too distant future. Pardon me. So you'll be able to see that very, very clearly. The net result in the position is a debit. It is going to cost more to buy the long-term option than we can bring in selling the short-term option, but not by a whole lot, not as much as you might think in some instances. So the goal here in a calendar spread, capture more time decay in the option we're selling than we lose in the option that we're buying. Calendar spread specifically can be done with all calls or all puts. So the scenario that I mentioned was having a stock that dropped and using the put options to take advantage of that. A question that comes up periodically is, well, if it works with puts on a big significant drop, what if you have a big significant move to the upside? Couldn't you do it with calls then? And it makes sense in theory, doesn't it? But in the end, it doesn't really work that way. I apologize for the coughing. You don't get the IV spike on a move to the upside, and stocks just don't tend to, when they get a big gap to the upside, go directly sideways. So you don't get the IV skew. You don't get that big IV pop. You get some, but not as much as you do to the downside. And then the stock doesn't necessarily go directly sideways after the big move to the upside. It usually either begins to fall back down or continues the upward move. So it just doesn't work as well when you're dealing with the call side. So we focus on put counter spreads with stocks that have had a big drop. Now, this is a delta neutral position. Thinking about delta, when you buy a put option that has a negative delta, when you sell a put option that has a positive delta, because selling puts profit from an upward move, buying puts profits from a downward move. That's where the two deltas come in. Well, we're going to be buying and selling the same strikes, so that creates a delta neutral position. So that's where the benefit comes in if the stock stays sideways, pardon me, throughout the movement of the stock. So looking at put calendar spreads on a risk curve. Perhaps you've seen a risk graph in the past. If not, this is what they look like. You have a horizontal line, which in this case represents the stock price. And then you have the vertical axis, which is profit or loss. If you sell a put That's what the risk graph looks like. You have limited gain. That's why that movement above the zero line breaks off. You can make money up to the point of what you sold the put for. You can't make any money past the premium that you sold the put option for. That's it. That's the most you can make. So you have limited your potential gain, and you have risk all the way to the stock hits zero. So in general terms, there's a good explanation or a good illustration of why we don't sell naked options. But if we add in the graph of a long put, totally different scenario. Now you have limited risk. So the line that breaks off and stays sideways is the amount of risk. You can't lose more than what you paid for the put. And now we can profit all the way till the stock hits zero. So what if we were to combine those two? Well, now you get a graph that has this dotted line that represents what the put would look like at expiration of the short put. So you can see it's risen a bit because now we've collected the premium on the put that we sold. So it takes away from some of the risk. Now a calendar spread, a combination of those two throughout the course of this trade, look at that V above the zero line, but pay special attention to the two lines on the outer end that shows you the trading range of the profit above that zero line. So what if we were to spend $5 on the put that we buy, bring $4 in on the put that we sell? That leaves us a net cost of $1. Remember, we talked about in a calendar spread, it's a net debit on the position. So if we have a net debit of $1, that's the most we can risk. If you look at that box in the bottom right hand of the screen, the max risk is $1. Look at the break-even points. To me, this is the greatest aspect of the strategy. We're talking about a stock that was trading at $50. The range is from 46 to 54. It's an 8-point range that the stock can stay in where you would generate a gain. And you can make as much as $2 on the position. So noticing that we were able to bring in $4 on a short-term option and spend $5 for a long-term option, how can you do that? Because of the difference in the time, that's where the skew comes in. That's the kickstart or the jumpstart in the position, is having that IV skew make that premium out of whack, if you will, hence the name skew, from the longer term option from a volatility standpoint. So you've got a wide area that you can generate a gain. And on top of that, look where those lines are underneath the zero line that represents the risk. They don't go very far down. It's a fairly limited risk position, and it is a debit position, which means you can't lose more than what you paid. I want to be very clear on that because it confuses some people when we start talking about combining a long option with a short option, when we're selling an option to open against buying an option to open. People that aren't super familiar with options, that becomes a bit of a question. You cannot lose more than the net debit in the position. It's still a limited risk position. So I think that is an extremely important thing to highlight. Sometimes these things fall in your lap. This is one of the things that really spurred this on. I was a financial advisor at the time, and then I had started trading on my own, and I had a few clients that came with me, and one of my financial advisory clients was a nurse, and she had an account that existed that I was helping her with in trading options, and then she had her little portfolio that she played with, which was all healthcare stocks, which I told her wasn't a good idea, but she didn't care. Anyway, one day she calls me on the phone. I'm sitting at the desk, and she says, "Have you seen Elan?" This was one of the stocks that was in her portfolio. They had this drug that was for Parkinson's and was showing great promise. She was super excited about it. And I said, "No, I haven't seen it today." And she goes, "The phase 3 trials results came out today. They weren't good, and the stock's getting killed. My portfolio is getting hurt." And I was like, "I'm really sad to hear that. I feel real bad for you, but I gotta go. Bye." Boom. And I hung up the phone. And that is a 100% true story. And the first thing that went through my mind when she said the words, "the stock's getting killed," were IV skew, calendar spread. There is the IV chart of Elon the day she called me and told me that they had released the phase 3 trials and they weren't going well. Look at the red line. That's the short-term options. That's the 30-day or less options. And then the black line is the long-term options, 90 days or greater. Notice the difference between the two. So we are going to sell the IV on that short-term option, the red line. We're going to buy the IV on the long-term option, the black line. The difference between those two is the skew. And that's where I was talking about. It's basically free money. Notice the rest of the graph, how close those lines are together. That's an important key, because after the skew exists, they're going to come back together. So if you sold that implied volatility when it was high, you brought that extra premium in, but you didn't have to pay for that extra premium on the option that you bought. There's the kickstart or the jump start. And again, sometimes the trades literally just fall in your lap. It's a humorous story. I've told it a lot. And question that comes up all the time, did you ever tell her that you did that? And no, I didn't. I never to this day have told her that I did that trade. I just, it hurt her that day, so I didn't want to rub salt in the wound, if you will. So the ideal setup for these calendar spreads, keep the entry debit as small as possible. We don't want to get too high, and you'll see that in some real examples here in a little bit. Select non-trending range-bound stocks, and one of the best ways I found to identify those is after the stock has a big drop, and look for that volatility skew. So the ideal volatility skew is if the implied volatility on the short option versus the long option represents a skew of 15%. And if you want to see how to calculate the skew, what you do is you take the volatility of the short-term option, subtract that volatility of the long-term option, take that difference and divide it by the long term. That's how you calculate a volatility skew. So again, the volatility of the short term, subtract the volatility of the long term, take that, divide it by the volatility in the long term. That's how you calculate a skew. And if you can get a 15%, that's great. I do want to stress that having a volatility skew is not a necessity for the strategy to work. Even if there's no skew there, you're profiting from time decay primarily. Remember in the headline, when we talked about the LA Wave options time strategy, it was profiting from time decay. That's the main idea. Just that IV skew is the cherry on top. So it's not necessary, but it's nice if you can have it. So I just wanted to clear that up. If you find one and it looks good, but it doesn't have an IV skew, then that doesn't mean you have to walk away from it. So I believe adding a strategy using calendars that benefit from time decay is great for our subscribers. It helps to offset the fact that theta decay is an enemy when you're primarily long only and you're directionally based and time decay hurts you. Well, now we have a strategy that offsets that where time decay helps you. So there's the folks at Hub, which created a program called Profit Source, which I utilize. It's an LA Wave software program. And I asked them if they could add in my calendar spread search criteria into their software. They'd done it before for some other programs. And then they came back and they said, hey, we've teamed up. We have some AI programming guys. What if we were to take this, because they thought it sounded pretty interesting just in general, if we gave this to our AI guys and let them run with it and see if they could refine your search a little bit. And I'm really interested and intrigued about the future of AI in general, not just in the world of technical analysis. So I said, yeah, that'd be great. If you're willing to do that, that'd be terrific. So they did. And they gave the search criteria, just the general search criteria that I'd created over the years for calendar spreads, and they put it to work. And so creating this unique algorithm using artificial intelligence, taking my original scan and adding over 300 new data points to consider. So what I originally sent them seems tiny in scale compared to what they did by adding over 300 new data points to it. So when I asked the AI guys to find a better way to identify this, it was to say, can we come up with something that gives an even greater percentage chance of the stock moving sideways, staying in a trading range, because that's the key. If you have the long and short option at the same strike and you're profiting from time decay, staying in the trading range is the key. So they set up a sophisticated algorithm. It was a lot more than just back testing an idea. Again, over 300 data points added in to create this algorithm. So the input data, this is just a basic sampling of it. Obviously, with 300 data points, we don't want to spend the time going through all of them, but it takes in price and volume data, indicator values, comparison to benchmarks, relative data rankings, statistical measures. Basically, what the AI is doing is using a regression-based model and neural networks. And if you're like me and initially saying, I really don't know what any of that stuff means, in plain English, what it means is that we're presenting the AI with a problem. And we're saying, hey, we want to see if we can find stocks to stay in sideways range. The neural networks is the AI moving through to create a solution. So you present a problem and it creates a solution. That's in general terms what that means. And so that was it. Can you help refine this basic search to where we have a greater chance of a stock staying in a trading range? And when I asked them if they could send me some information to where I could help explain what they were doing, this is what they sent me. And this was just a sampling. This isn't all of it. Obviously, this isn't 300 data points. And I looked at that and was like, I have no idea what that means. And they said, well, here are the most important coefficients for each of the 3 sideways models. The catch here, though, is that each final model is a combination of 4 models. Let's set up a time to go over the nomenclature. I was like, I don't think that's going to be necessary because I have no idea what that means. And if you try to explain it to me, I still don't think I'm going to understand what you're talking about, but I respect that you do and you understand it. But I'm a visual learner. You know, if you've been through the things that people learn in different ways, I'm a visual learner. So I said, hey, can you show this? Can you illustrate this to me? And we've talked to our subscribers about the delta curve, and the delta curve made so much more sense to me from when I read text about it to looking at the illustration, the picture of what a delta curve is. So again, I'm a visual learner. And so they said, okay, sure, we can send you some images. And this is what they sent. And these are the various data points. You can see all the stuff across the top, which matches into those coefficient tables that they sent me. And I looked at that and said, yeah, that looks really cool. And I'm sure that those groupings, those tight groupings are meaningful, but I still have no idea what that means. But it's pretty cool to look through some of the pictures of the data points. So each one of those is a different data point. You can see the outcome listed on the top of that. So each one of those is a data point that shows the outcome. And then they sent me this, which is really cool, which is a depiction of the 36 most important correlations. Remember, there's over 300. That's only 36 of them. So you can imagine the amount of data that went into this. And that's where I think the cool stuff of AI is, because it's endless, right? And it grows and it feeds off of itself. And that's what AI is in general terms. So if you can imagine taking those and you see all those graphs where you have these significant groupings, and each one of those is growing and feeding off of itself, just to create a chance of a stock staying in a trading range. Can you imagine the power of that and putting on strategies to take advantage of that? That, you know, it sounds like a whole lot of data and mumbo jumbo, but in the end, it's that serious. It's that simple, really. So looking at the results, because that's the key. I can talk about all that other stuff and you're just going to say, does it work? That's the bottom line. Well, we tested the AI algorithm to identify stocks that it forecasts. So we tested the results that it gave us, the signals that it gave us. The AI rates them from 0 to 1. So it gives each result a rating. We used over 20 years of data that started from the beginning of 2001 and ran through August of 2021. We stopped in August of 2021. You may wonder, well, why did you stop in August of 2021? Because we were convinced by then with all the data that we had looked at, and that's when we started trading it live. We started trading it live in the beginning of September. But during the 20-year period, we found 7,562 signals. So this is not a little tiny sampling of data. This is an extensive amount of data that went into finding this information. Now, one of the things I want to share this with you before we move forward, and I'm going to show you the data here. Even though I originally sent the search to them, the guys, the AI guys, found this to be so powerful themselves, they are not giving us the intellectual property. They won't let us have it. They said, that's theirs. And I was like, well, I gave you the information to start with. Well, we don't care. All the AI stuff is ours. And so we get the signals from them, but they're keeping the intellectual property. And I'll explain a little bit more about that later in the presentation as to what their reasoning was for keeping the intellectual property. But if you've ever seen a line graph like this, or a dot grouping, if you look at this, the bottom low here, the horizontal axis down here, is that rating from 0 to 1. Remember that the AI gave each result a rating from 0 to 1. And then the vertical axis is the percentage of profit, or percentage of it staying in the range. Technically, it's the percentage of staying in the range, but if the stock stays in the range, it's going to be profitable. So they kind of go hand in hand. And when you look at the dot plot there, even if you don't have a lot of experience with this, you'd have to say that's a pretty impressive grouping along that 45-degree angle moving to the upside. Now, if you had a system that was going to be profitable 60% of the time in the world of trading, that's a great system, because you can make money and make money consistently if you're right 60% of the time. Well, in this scenario, stocks that would stay within the range, which means that they would be winning trades, had a value of 0.75. Remember, that scale was from 0 to 1. So the intersection between being right 60% of the time, or staying in the range 60% of the time and generating the gain, intersected with a rating of 0.75. So that was our starting point, but it gets better. Take a look at this grouping here. What the blue lines represent are stocks that after the drop, they either stayed in a sideways range or drifted lower. Now, remember, we're using put calendar spreads. So the long put is protection. So a stock that drops lower doesn't hurt you because you're being protected by that long option. Now, look what that did to the number when you add in stocks that came down and stayed sideways, are then drifted lower. That brought it up to 85% of the time. So if we're putting on the majority of the trades being put counter spreads, and we're going to give you the breakout of the different strategies, because it isn't only put counter spreads, to be fair, but if you think about a strategy that's main protection is if the stock were to go lower, so it doesn't necessarily stay dead sideways, it goes lower, then you're protected, and that ups your percentage of staying in the range or being profitable up from 60 to 85%. Now you really have something. You can see why we're focused on the put counter spreads. You can also see why we're so excited about this strategy and where it's going to fall starting in 2022. What a great year for this to be released and start. Now, the results there, the number of results, you can see they peak at 0.75, but even if we were to go and look for higher ratings above 0.75, you can see there's tons of results there as well. So we look at 0.75 and above. So anything that looks at 0.75 or higher are the ones that we consider. So there's plenty of trades to look at. So if one of your concerns might have been, well, yeah, if you have all of these data points, how many results can there be? A lot more than you would think. There's plenty of trading opportunities, so that's not an issue if that is a concern. So let me introduce to you the new EWO Options Time Strategy. So basically, it's a non-directional strategy where we expect the stock to stay in a sideways range. So we're looking for stocks to move sideways. It comes from a pattern of having a stock that had a significant or a gap down. I like the gap downs, and this is one of the occasions where I actually like a stock that gaps to the downside. Sometimes you look at, you don't want a gap because the gap's going to get filled. Yeah, but when you have a big gap down, it doesn't really work that way. You have a big gap down and the stock kind of goes into shock, stays sideways. That's what I used to call it. It's almost like the stock is just in shock and goes dead sideways, like a EKG of someone with a heart attack, etc. Kind of feels like that's what happened to the stock. We're going to profit from that IV. Now it says rush and crush. What does that mean? Well, The rush is that IV spike that I talked about. So the IV spikes, that's the rush. We're going to sell that. So we sell at the peak of the rush. And then as it crushes back down, we profit from that. As I showed you in the IV graph, the IV on the short-term options up here, the long-term is here, and it comes back down. So we profit from that. So we sell the rush and profit from the crush, if that makes sense. And in addition, the one aspect that we talked about that occurs in options, that's a given, it's a fact of life, nothing you can do to get away from it, is time decay. So we profit from both of those. Now, the strategies we've talked about a lot, put calendar spreads, but diagonals also work, as do butterflies in given situations. I'll talk about that in a second here. So we're looking for stocks with an IV score of 0.75 or greater. Just some of the characteristics that we're looking for in the option side of things. What's the availability? Do they have the appropriate months? Are they liquid? Is there good open interest? What's the cost? We want to keep the cost as low as possible on that put calendar spread. That was one of the rules. Margin comes into play if you're dealing with a diagonal. Now, I can argue as much as I want with the powers that be, with the principals, with their guys in charge of risk management within the brokerage firms on it's still a limited risk position. There shouldn't be margin. And sometimes they agree with you, but they say it's the rules. We have to charge margin. So I'll cover that in a minute. Calendar spreads, just want to be clear, no margin requirement, but they are in diagonals. Now, another interesting thing, weekly options. They really juice the premium in weekly options. I talked about how we're this instant gratification society. We want everything now, now, now. And so we tend to do things on the short term. When they started releasing weekly options, they exploded in liquidity because now we don't have to wait a month to see if we're right on direction. We can do it in a week. And knowing how many people buy those weekly options, and you have to be right within a week's time, they really juice the premiums there. So even without an implied volatility skew from the drop, there's extra volatility in selling a weekly option. So if you're interested in trading weekly options, this is a great strategy for you because the data from when we sold weekly options was fantastic as well. So it fit in there really well. So let's take a look at a real trade that we did using the stock Zoom. So there you can see the stock had a big significant drop, dropped 16%, and there's the standard deviation range. So that's what the AI is telling us. There's the range that the stock is likely to stay within. If you look at the risk curve over on the side there, that's the risk graph of a calendar spread. So you can see where the stock is, and you can see this range. Now note the wings on the calendar spread. They move outside of the shaded area, which represents the standard deviation, which means you could even have the stock move a little bit outside of the range that's expected and still generate a gain on the position. So that's pretty cool. Now, the cost on the calendar spread was $900. We mentioned keep the cost as low as possible. That's a really expensive put calendar spread, kind of outside the norm. So when we look at that, we could add in, all right, well, a butterfly is only $315. Well, note the wings aren't nearly as wide, so you need it to stay in the range more with the butterfly, but a significant reduction in cost, a third of the cost, if you will. A debit diagonal position looks like this, which is the risk graph in the purple color there. Again, moving outside of that standard deviation range. And then at times we can put on credit diagonals where you actually receive a credit in for the position. Remember, the two diagonals are the ones that require margin. No margin on butterflies, no margin on calendars, but yes on the diagonals. And you can see that the credit diagonal, basically the least amount of risk of any of the positions here. But we have a mathematical spreadsheet where after we get the data signals from the AI, we then input this information, the option pricing, etc., and it tells us which position we should put on. And it's right a high percentage of the time. Nothing's 100%, but it's right a high percentage of the time. So you can see there's a lot of math that's involved inside of this strategy. So the calendars and diagonals both profited outside of the AI's forecasted range, but using that spreadsheet, and inputting all the data, it showed us the best situation for this data that you've given us and put in, including risk management, because if you have margin, you have to calculate that as risk, right? Because you are putting up margin. So that's the same thing as if you paid for it. So if it was a debit position and you paid that amount, even though you're not necessarily paying it, they're holding it in your account, in a margin account. So we count that as money at risk, which I think is the fair way to do it. So all that information goes into the spreadsheet. Well, spreadsheet said in this case, everything considered, the butterfly is the best position. Well, in the end, take a look at the results. Now, what we did was we showed the results of each of the different strategies with their varying costs. And if you look at the butterfly, it represented a 242% return on that trade. That's a $763 profit. If you look at the put calendar spread, it's only 146% return, but you could look at that and say, but look, that made $1,300. That made $600 more than the butterfly did. But look at the significant difference in cost, $300 versus $900. The butterfly costs a third. So if you were willing to put $900 into a trade, you could have done 3 butterflies. And now all of a sudden that $763 turns into over $2,200. So, you know, at first blush, it looks like, well, the calendar spread would have made more. No, not when you're taking into account risk, which is what our spreadsheet does. Notice that every one of the positions made money. And so we went all the way from an 8.79% gain that the put diagonal, the debit diagonal would have made versus 242% that the butterfly made. So, I mean, the amount of money that you can make, you're thinking the stock's only going sideways, so there's going to be a limited amount of gain. And in all fairness, this was a great one. They don't all make 242%, but the percentage of accuracy is extraordinarily high. And so let's take a look at those trading results. I think this is going to be very impressive to you. Actual trading results. So as I mentioned to you, we tested this through August of 2021. Then we started actually live trading this. And after we started live trading this, we issued this and we allowed our alert subscribers to have access to this first. So real world testing before we gave it to our subscribers. And then that period of live trading was from September till now. All of this information is available to our members on our website, EWOtrader.com. You can see all of this information here with all the results from the live trading. But for here, I'll share it with you while you're watching this presentation. Again, all of you live streaming, hope you're enjoying the presentation, hoping you're finding this interesting and that this is a really exciting time. We feel like it is. And again, we feel like we're on the cutting edge of what's coming in the world of technical analysis, which is AI-based trading. So here's our actual results since we started trading it live, and that's September 1st through the end of December. We had 41 closed trades, 32 were winning, 78% winning ratio. The average return, look at that, 121.8%. That's the average trade return, 121%. But look at the average trade size, $336. We try to keep our alerts at $500 of risk or less per alert that's sent out, significantly below that at 336. The average time in a trade, just over 20 days. Our AI has shown us that right around the 21-day time frame is ideal. Why? I don't know. It's a Fibonacci number. Does that matter? Who knows? It's interesting, if nothing else. There's some that are a little bit less. We just closed one out that was 16 days. Some are a little bit more, but that average is right at the 21 days. The cumulative return has been 262%. And we had a period of time where there were 13 consecutive winners. The maximum losers in a row was 2. But take a look at the equity growth in the account. The orange is realized gains, and you can see how it moves. The blue is unrealized. So the orange is realized, the blue is unrealized. Maybe the most exciting thing of everything that I've shared with you, if you're a person that doesn't like drawdowns in your account, if you just don't have the stomach for it, understanding that it's part of trading, take a look at this, the unrealized portion. Rarely does it go below the zero line. So rarely does it even go into a position where there's an unrealized loss. That's what's most amazing. And then you can see the growth of the closed or realized gains in the orange. So you're not going to see significant drawdowns in this position because of the structure with everything that I've explained to you. And so that's key. You don't have to have an iron stomach to trade options anymore. That's why I think one of the most exciting things of all of it. If you want to know what's the spread, okay, well, in September, there were 6 trades, October 11. Now look what happened in November, 24 trades. Why? Earnings. Guess what's coming up at the end of January and February? Earnings season. It just started kicking off. So what an ideal time for you to be viewing this, and an ideal time for us to be launching officially this new time strategy. There were 2 trades in December, and you might like, well, only 2. Well, through the 20 years of data that we researched, December was always the quietest month. Pardon me. So a couple reasons why. It's quiet. Things are quiet, and there's always the expression, never short a dull market. So in December, you don't get a lot of stocks that have significant drops, and there's not a lot of earnings in the month of December. So that wasn't a surprise, because again, historically throughout time, December was the quietest month of the year. Around earnings season, probably the most exciting point of the year. So let's break this down. Here's the proportion of the strategies selected. Notice that the calendar is number 1, it's 61%, but it isn't the only strategy. Better than half the time, we're doing put calendars, but not all the time. 17% were butterflies, and also 17% were credit diagonals, and 5% of them were debit diagonals. So the put calendar spread dominates. That's why we featured that strategy in this presentation. But note that other strategies are utilized as well. And here's the percentage of win ratio by strategy. So the diagonal, you can look at that, 100% win strategy. And you're like, why don't you just do diagonals every time? Don't forget, diagonals take margin. That has to be calculated into the risk formula. That's what's put on our spreadsheet when it tells us which strategy to use. So all that information matters. So don't forget that when you're saying, well, I'm just doing diagonals. It's not quite that simple. You look at all the other things. And in calendars, you look at, well, that may have had the lowest percentage of win ratio, but in a lot of cases, it's also the least expensive. Here's the average return. Now, you would expect this. If you have a butterfly that works well, that is a hard strategy to beat. You get a butterfly and the stock stays in that trading range and goes towards expiration. Very, very difficult strategy. I don't care what you're doing unless you hit a 300-point run and you just long a position. Other than that, it's tough to beat in the world of trading options, a butterfly, and that's reflected here as well. And then you look at the 2 diagonals. Now they're lower here because margin is factored in to the returns, and the next best strategy is the put calendar spread in this scenario. So that all makes sense. I just mentioned to you, earnings is a pretty good time for this strategy. And you can look at that graph there, the other pie chart in the orange, 56% of the time it's on an earnings report, but that's a little only half. So if you're looking at this, well, this is only a 4-month of the year strategy because it's only going to happen during quarterly earnings. No, there's plenty of other opportunities as well. Yes, it spikes up around earnings, and that's a great time, but you can find opportunities at other times as well. 29% of the time we're between earnings reports. So we're in between earnings reports and something happens that creates the signal. And then 15% of the time we trade through earnings. You could see that that was probably a little more of a risky proposition, right? You're going to trade through an earnings cycle when you're expecting the stock to stay in a trading range, and the results bear that out. Only 15% of the time are you trading through an earnings report. So take a look at this with the trades open, September, October, and November, and then the color coordination between through, between, and on earnings reports, and November being a prime month for earnings. Again, don't want to report earnings in December, so everybody gets it out of the way in November, and you can see there was a ton of them. That's why there were so many signals in November. And again, we're getting ready to head into that into February again, so just a premium time for this. And the win ratio. notice that kind of an interesting thing, that if the signal was initiated between an earnings report, it was 100% winner. All of the signals that were generated between earnings reports were profitable. And then those that came out on an earnings report were right about 80%. And then trading through an earnings report, again, I think that makes sense. The percentage of accuracy drops down because we all know that earnings move stocks, right? Or in general terms, earnings move stocks. So trying to trade in a trade or stay in a trading range through an earnings report is kind of a challenging thing. And that's borne out there really well. So how can you access these alerts? Well, the way LA Wave Options works is we try to educate trade by trade. We run daily scans to identify trade candidates. In this case, it's the AI running the scans. And then we do an LA Wave analysis to select trading candidates. We send out alerts to our subscribers in real time. And those alerts are sent out via text and email. So SMS and email, or both, if you prefer, that's fine with us. And then we go through the management of the trades. New trades are added to our website. We have a whole trade listing. Every single alert that goes out has its own position there on the trade listing. And this is what it looks like. You can see going through and listing each of the individual trades and all this information that comes out. We have a detailed analysis for each alert that's sent out. So it gives you the exit, entry, whatever the situation is, what was the strategy, what portfolio was it in, a description of what the position was designed for, why was it selected, etc., what's expected to happen, and a chart analysis for each individual alert is sent out and included in the listing on our website. So you can see it. If you get an alert and go right to the website and take a look at the chart, see what it looks like. Here you can see on DVAX, there was the support level, there was resistance, there was the trading range that was expected. And note that this was one of those that was in between earnings. You can see where the little blue E was there in the beginning of November, and the next one is in February. So this was an alert that was sent out because of a signal that was given in between earnings. So I'm just kind of giving you a real life example there. Review all position, every trading session, obviously, and then we'll send out alerts for any adjustments and exits. I know there's a lot of alert services out there that will send out alerts for entries, and then you're on your own. Well, we send out alerts for any adjustments that are made. Really, there aren't adjustments in the time strategy, but other portfolios, we do have adjustments. We send those out, as well as exits, when to get out. And it's not just as easy as I just close it at 21 days. And there's a few other things to consider. That just gives you, that's where the average is. So we do a full trade analysis of all of our positions, and you have the opportunity to ask questions about any of our trades every week. We do an insiders meeting every single week, where on Thursday night, our alert subscribers only have a webinar for them, and it is live interactive. You can ask questions directly to me about any of the alerts that are sent out if you have any questions, and there's all the information that's included. So we go through a full analysis, including reasons for entries, exits, adjustments, etc. We cover all that information every Thursday night in our insiders meeting. So if you have a question regarding any of the information that's on that screen, or at the very end, you can ask general Q&A on other things too. If you want to, it's your meeting. We set it up for our insiders. So if you want to ask me a question directly, you can do it by voice. So it's very interactive. You can unmute yourself and ask me a voice question if you'd like to, or you can send it in through text, and our support staff will read the question for you. But it's a talkback format. You send me the question, I answer it back to you immediately. So it's not just via email or submit a question, whatever. It's live. We're going through it at that actual time zone. And in addition, we really pride ourselves on the quality of the education that we have on our website. Trader education by video and text. We have sections that are called premium and those that are called mastery classes. And we talk about our Ellie Wave option strategies. There's the time strategy, the volatility strategy, which is basically strangles, and our impulse strategy, which is different types of trades on directional based charts. So those are in the light blue. So they're included in the premium. Notice that these are mastery level classes, where the impulse pattern and the zigzag are in the darker blue there. Those are mastery level classes where the Ellie Wave core is a premium. So the lighter blue are premium, the darker blue are mastery. What's the difference? Well, the premium classes are included. All the education that's contained in there is included with our alert subscribers subscription. Any of the subscription portfolios they have, all that education is included. The mastery level classes are things we do in addition, above and beyond that, and our subscribers pay additional for that. We also have education on options trading. So we don't just limit it to technical analysis. Options are important as well. I always talk about how selecting the right option is just as important as the right chart pattern. A good Ellie Wave pattern, having a good options trade is more important than the chart pattern. So we have our boot camp, our jump start to get you started, and then we have mastery classes on our different strategies that we can go through. Same thing with our indicators. We have all our different confirming indicators. We're primarily Ellie Wave, but that's not the only indicator that we look at. We have other indicators. That's what creates the technical trading system. And the AI has created a system for this time strategy. So even our other portfolios are system-based as well. We don't just rely on any one indicator for any of our portfolios. I don't think that's a very smart thing to do in the world of trading. So how can you receive access to these alerts? Well, our level 1 is the time strategy. So you get that strategy that I've just spent the last several minutes going through and explaining to you, and that's at $99. And if it was just the alerts, that would be a fantastic deal. But in addition to the alerts that are sent out via text and email, it also includes the chart analytics and plan for each trade, the insiders meeting on Thursdays, and member access. So again, you can send questions directly to me or to our support staff, and your questions, importantly, are answered. You don't just send questions that go into oblivion. You've probably experienced that before. And all of our premium level education, all of that is included for $99, not just the alerts that are going out. In addition, something for you to consider is the fact that we are limiting this. Now, we've already shown this to our alert subscribers. They've had access to it, and our Trade Finder subscribers have had access to it as well. So we're live streaming this because we have a few spots left, and this sounds like just marketing BS, but it's not. There's a limited amount of spots available. Now, I told you I was going to come back and explain to you why the AI guys won't give us the intellectual property, because those IV SKUs that are so cool, not necessary, but really the cherry on top, exciting stuff that goes along with it. They don't want the whole world to have access to this. They don't want us going off and selling all of these alerts to a whole bunch of different people. They want to control it. So they want to make sure that there's a limited number of people that trade each of these signals that come out. So they're not going to give it to us. We just get the results, or we get the alerts that are sent out. And they're not going to give us the intellectual property. So they're serious about the fact that there's going to be a limited number of people that are trading this strategy. Do you want to be one of those people? Well, I think you'd be really smart to take advantage of that. Why do you consider us Ellie Wave Options? Well, for one thing, we're easy to get started with. We don't require any year up front, so there's no upfront costs. We just go by the month. You sign up for a month at a time. You don't like us, it's easy to cancel right where your subscription is. You log in, boom, you can cancel it. Just go a month at a time. No upfront costs, no contracts. You're not signing a contract to go through for a certain period of time. We offer our premium education and no additional fee. The live insiders meetings every Thursday where you can ask questions directly to me. We have interactive support. There's support staff that can ask any general information questions that you have aside from this. And learning from somebody that's been there and done this. Remember that this time strategy came from my general search. Now they took it and they, they made it much better. No question about that. And they took it, supercharged it, if you will. But it was originally my strategy. And when I first started trading, I had some successes, I had some losses, and I was advised, latch on to a mentor. Find somebody that's been doing this for a while and doing it successfully and learn from them. And that turned my trading around over 25 years ago when I first started. And so I'd like to offer being that for you. Just learn from the fact that I've been doing this for a very long period of time. I think experience is the greatest thing that I offer. In addition to all of our education, we publish our track record. We are walking the talk. We show you exactly what we're doing and what the results are. And if you choose to follow along and place those trades in your account while you're going through the educational process, you can learn while you earn. So with all of that said, the $99, because of this, the fact that you're watching us on this live stream, we're launching it. It's our official launch of the strategy. We're going to give you a $10 a month discount if you sign up between now and January 31st. Now, I kind of want to throw a little carrot out there. The special lasts until January 31st, but if we fill up before January 31st, we'll shut it off. So this is not guaranteed. So in other words, you can't necessarily say, hey, on January 31st, I'm going to sign up for the $89. If it's full, we will stop it. So I just wanted to be super clear on that. The AI guys are very intent on this. There's going to be a limited number of people that are doing this, and then that's it. But if you do take advantage of the $89 special, you're grandfathered in at that price forever. And one last thing to sweeten the pot just a little bit more for you. If you haven't already figured out that this is a no-brainer, what have you got to lose? Try it for a month or two, go through earnings season through February, see what happens. We're going to throw in the mastery level education, the stuff that our alert subscribers normally pay extra for. We'll include all of that, which means you have access to all of the education on our website for free, and you're getting a $10 a month discount if you sign up. Again, sooner rather than later. The special officially goes off January 31st, but as I said, if it fills up before then, it's done there. So you can look at the link at the bottom, ewotrader.com/preview-offer. That's where you go to sign up. And so don't wait. I mean, if you found this anywhere near as exciting as we are about this, or at least are curious about it, to give it a try, we do think this is the future of where trading goes. At this point, John, are you there? All the way from
Rob, yes,
down under?
I'm here. How are you?
Good, John. How you feeling?
Feeling very well. Got a few questions from people out there, if you're ready to take them.
Sure. Sounds good. Let's go.
First question's from Ken. He's asking, do you exit by selling both options, or do you continue to hold the long one?
That's a great question. And that actually has come up before on that. There are times when once the short option, if it goes to expiration, so, that depends on how many days are left to expiration when you sell the short-term option. And we're looking at generally 21 days. What if there's 19 days to expiration when you sell the short option, and that's where the great skew is, et cetera, then there's a good chance that goes to expiration. So do you close the long or do you hold it? I think that depends on your motive. Now, in general terms, we just close the position out. That's the end of it. And I'd be lying to you if I didn't say that there was, because we've done all this, right? We've got all this research and all this data, and there have been positions where after the close of the short position, had the long stayed on and the stock drifted lower, you could have enhanced the position, but no, then you're directional. So you've changed the game if you keep that long put on after the short put has expired or been closed out. You're now directional. So you're taking on that risk, and the premium that's in there, if it were to bounce to the upside, you lose that premium, and you could risk losing some of the gain that you'd made in the short option through time decay and the drop in implied volatility. But again, I'm just trying to be as fair and honest with you as I can. Those are the risks, but the rewards have been, there's shown some that where the stock did continue down and it did greatly enhance the returns. So, it's all risk reward. That's what the world is. And what we're trying to do is find a system here, which we feel like we've done with Time Strategy, has the best risk to reward ratio of any strategy that exists. But if you're willing to take that additional risk, yeah, you can let that one run. We tend not to do that, but I wanted to be fair with you on answering your question.
Thanks, Robin. And a kind of related question, Jim is just saying, do you use a stop loss to exit if the position is losing money?
That's kind of where it depends. In general terms, yes, if a position is completely falling apart, but they tend not to go into huge positions of loss. Um, but the general thing is the 21 days. We kind of want to give it that. That's the average. And we've seen from our mark-to-market graphs, which Mark, and that's on our website as well, by the way, the position every single day where some positions have gone down, but you saw the unrealized gains and losses. It doesn't happen very often, but it does happen at times where the position does go into a loss. But we kind of want to give it that 21 days. Our AI telling us that's kind of the sweet spot. But if a position really is looking poorly, yeah, we would close it out sooner than that. But the 21 days, we want to keep it there. And luckily, there just aren't many examples where things didn't go decently.
No problem at all, Robin. I've just got a couple of questions, and one's just come in from James and another from Steve. Does the level 1 subscription include the impulse and volatility services? And the answer to that obviously is no. We've got level 2 and 3 if you want to add in the other services. The related question from Steve is, what if we want to subscribe to the other strategies? Is there a discount for those?
I'm sure that we could work something out as far as, this is the brand new launch of the time strategy. And as you said, John, level 1 is the time strategy. So it does not include the other portfolios. But if you were interested in other portfolios, because we're offering a special on the time strategy, I'm sure we'd be willing to work something out from a special. I don't want to speak in front of the rest of the team here, but I would ask you to send in a message to support, ask the question, but I'm sure we work something out as far as a discount on the other portfolios as well. I don't think that would be fair to say, oh no, it's only a discount on this one only. If you were going to include this one in the other packages, obviously would work something out with you as well with the other strategies.
Okay, great. Thanks, Rob. Graham is
asking.
asking.
I should point out, John, just one, I'm sorry to interrupt, and this is really off the subject a little bit, but the AI worked out so well on the launch of this time strategy that we actually had them do some AI on the risk management and the volatility portfolio, which gave some eye-opening results for me, because that's kind of how I kind of made my claim to fame in the world of options, was through that strategy, and that fine-tuned that one. And they're working on the impulse strategy now as well. So AI is getting through all of our portfolios. We focused on the time strategy because we're so excited about that. But if you are interested in the other portfolios, know that AI is having an effect on them as well.
Thanks, Rob. And Graham was just asking, how realistic is it that a subscriber would be able to get the same prices as the alert?
Oh, a really good question. And that's why on our website, when we send out the alert price, we don't front run. Okay, so we don't try to fill a price until after we have received the alert ourselves. So we send out the alert, and once we receive it, then we try to go get it filled so that we're on the same time frame as our subscribers would be. And then when we get a fill price, we post that on our website as the actual fill. Now, often it's awfully darn close to the alert price. A lot of times it is the alert price at the time, kind of depends on how much time you have, but not always. And that's why we list the detailed filled price. And so our guideline to our subscribers, as long as you can get filled within 10% of our fill price, go ahead and place the alert. So timing matters, right? We talk about this, and we try to say you really need to try to get your alert filled within 20 or 30 minutes of when the alert sent out. And if you're in a scenario where that's not realistic, well, you need to focus on that 10% standpoint, because the truth is stocks move, options move, and it happens. But as long as you're in a scenario where you feel like you have a reasonable opportunity to get filled within 20 or 30 minutes, your opportunity to get filled where our price is extremely high. And so if you're outside that time frame, then you want to look at the 10% rule. Sometimes the next day you can still get filled within 10% of that price, but it obviously drops off after that. But those are in general time frames and guidelines. But generally, if you're able to get to your computer or your phone or wherever you trade from within a reasonable amount of time frame, you're going to get filled within that 10% of our price. So you'll get awfully close.
And I think, Rob, something that I could add to that is that the entire track record on the website you can see is actual fills. It is listed next to each of the details on the individual trades, what the fill was for that trade. So the track record that we're looking at is not the track record of our theoretical prices, it's the track record of fills. So coming back to the question about would it be realistic for a subscriber to get those prices, the short answer is 100% yes, because that's the fill pricing that we're using.
Yep, absolutely agree. Yeah, and that was a great point, John, that all of the track record is from fill prices, not these aren't theoretical prices. These aren't just, okay, if it were to get filled here, this would have been your result. No, these were filled. These are actual fill prices that are posted on the site. We know that we got filled there.
And there's a question from Michael who's saying, regarding put calendar spreads, a 7-day short option may drop more percentage points than the long 90-day, but the long put will generally lose more dollars per percentage point. What is a 20% collapse in the near short option? I think he means, what if a 20% collapse in the near short option is washed by the money lost on an 8% implied volatility long option? So sorry, a bit of a complicated one to throw at you there.
Yeah, and I'm not sure that that I agree with that. If a stock were to drop and the long option would lose more than the short option, if you're dealing with a 7-day or less option, maybe you're talking about the fact that because of delta and gamma and everything are higher on a shorter term option, and delta and gamma are higher in the last 30 days, and as you approach expiration they go exponentially. Perhaps you're talking about that, but I would argue that the other side of that with a weekly option, I think that argument might make a little more sense on a 1 month versus a 3 or 4 month option. But on a weekly, the time decay is so significant when it drops that if it starts to go down, they're going to get rid of the extrinsic value so fast before they get into intrinsic value, which is where the delta and the gamma could affect you with, getting past a 50 delta and starting to get into intrinsic value. That could be a scenario. But our experience has been, and we've had 20 years of looking at these now, granted, a small percentage of them have weekly options. So it hasn't been a massive sampling, but our data has shown that the weekly options work amazingly well. There hasn't been a significant hurt or decrease in performance. It's been a significant increase in performance. So could there be a rare instance? I guess there could be, but I just feel like if the argument is on the delta gamma on the short option, I would argue that the theta part of that offsets that because it's so significant in weekly options.
Thanks, Rob. Question from Nancy. She's just saying, I'm unfamiliar with placing a diagonal or calendar option. Do you assist the subscriber? I use the Thinkorswim software.
Well, Thinkorswim has, if you right click on your position when you're going to place a position and it brings up that screen. Tom Sosnoff was a really good friend of mine, so I know the Thinkorswim platform very well before he sold it out. But if you right click on it and it brings it up, there is a line there for calendars and diagonals. So if you feel a little unsure with it, you just click on that and it walks you right through how to put the position on. So it's very simple if you're using the Thinkorswim platform. So even if you're not familiar with it, they're preset. In other words, you don't have to go manually put it in. So you just right click and you can click on the calendar and so you make sure you click on the put side, right? So you right click on the put side on the option that you're selling, click on calendar, it'll bring it up for you. And same thing on the diagonals. So the diagonals are not the same strike. So if you're wondering what's the difference between a calendar and a diagonal, calendar spreads, short-term, long-term, same strike. Diagonals are short-term, long-term, different strikes. But it's preset. The window is preset for you. All you have to do is input the strikes.
Thanks, Rob. Actually, Jerry has a similar question about Thinkorswim. So I guess, Jerry, I'd just say if you wouldn't mind to write into support on that. We're getting into some sort of the details about using Thinkorswim and probably for another forum. But there is a question from Julie, who's just asking if the AI looking specifically for earnings announcements.
No, not specifically looking for earnings announcements. It's just the data that we gave you around earnings was just kind of eye-opening that a lot of these drops, the drop is one of the keys, tend to occur around earnings, right? Because if a stock comes out and disappoints, you know, a lot of times they, you know, used to use the expression, take it out behind the woodshed, you know, the old expression, you're going to go get a whipping. They whip the stocks pretty good if you disappoint on an earnings report. So one of the data entry points is not looking at the earnings report. It just happened to be that because of all the data it's looking for the drop and the potential to move sideways, et cetera, tended to occur initiated from an earnings report. But so no, it's not only focusing on earnings reports. And I wanted to be super clear on that one slide that, you know, 60% of the time it happens on an earnings report, but that means 40% of the time it doesn't. So it's not an only earnings-based strategy. It's not.
Thanks, Rob. And actually, I just got a message in from one of the AI guys who's watching who says the AI specifically is not aware of the earnings. They don't tell it that it's an earnings. So it's just picking it off the technical analysis.
Oh man, I'm glad you didn't tell me that one of the AI guys was watching before we started. I would have been really nervous the whole time.
Well, I think, Rob, that's all of the questions handled that we have. So I'll hand it back to you.
All right. Well, thanks for your questions. And again, thanks for everybody that was live streaming. We appreciate you spending your time with us. And we just hope you're as excited about this strategy as we are. I mentioned in the very beginning, if you didn't join us in the beginning, that even on CNBC last week, they had a headline on AI and the future in the markets. And I think we're in the front of it. We're leading it. We're heading out. One of our AI guys on the presentation tonight. I think that's really cool. And that shows their excitement about it as well. And so I think that this, you know, it's a no-brainer. We've tried to make it as much of a no-brainer as possible just to come kick the tires, see what you think of it, see where you think or the future of AI is. So I'd love to have you come along, and not kidding about the fact that once it's done, it's done. Maybe the AI guy was wanting to make sure we didn't give away any secrets. I don't know, but they don't share them with us anyway. But take advantage of this. I think you'll be pretty impressed with the results. Go to the website, take a look at all the past results, and you can see the amazing results that have come along with it. So we're excited about the official launch today of our EWO Option Time Strategy. Thank you so much for your time and joining us. Always sign off the same way. Time is the most valuable asset we all have. And we appreciate you devoting some of your valuable time for us. And we do our best to make it an informative and educational use of your time. One last thing, the special ends January 31st, but if you wait towards the end of the month, you do risk not having a spot. So just not committing to the fact that this will be available on January 31st. If we're full before then, we're full. Thanks again, everybody. Have a great week. Look forward to talking again next time.